Well, good afternoon in South Africa. It's still morning here. It's in fact 10:30 in the morning here in London, and I'm Alec Hogg coming to you from our new headquarters. It's quite funny to say that, but our new London headquarters. And of course, I'm here bringing you up to date on the SA Champions portfolio in Johannesburg, as ever, is our managing editor, Stuart Lowman.
Thanks, Alec. Always good to be here. Good start to the year. I think it's our first one for 2018, so very exciting. I know you've got a few changes for us. Just before we get into it, can I just see a show of hands just to make sure that everyone can hear me? And there we go. They're already coming through. That's excellent. Thanks a lot. We do like to keep the presentation quite interactive. So there is a little questions toolbar. It's on the toolbar on the right-hand side, the GoToWebinar control panel. I see I've got a couple already. So I suspect everyone knows where we're going with that. So if you just plot them in there, and I'll pass them on to Alec as he runs us through the portfolio. But over to you, Alec. Thanks a lot.
Brilliant. Thank you, Stuart. And just to make sure that you know, I am not kidding you. Here we are. And I think well, there we go. You've got a black cab going in the background. And this is in the WeWorks offices where we are based, which is on the South Bank of London. So you're coming to another part of the world this morning. It does help us in our global coverage for Biznews. But today the story is very focused on our Champions portfolio, and we've got a lot of ground to cover. So let me go straight into the presentation. Right, Stuart. There we go. Okay, first up. Our mandate was to hedge against the rand by investing in global companies driven by South Africa's best entrepreneurs. Now, we did deviate a little bit on that, as you would have noticed with Mediclinic, for instance, and certainly with hindsight, Marcus Jooste is no longer anywhere close to being one of South Africa's best entrepreneurs. But it was our attempt. We had a relatively small universe from which to pick from. We did miss some of the big smashes, thank goodness. And we were very fortunate in getting out of Brait just 1 month before the whole Steinhoff debacle hit. It looked good at Brait for a period of time. And then the more we looked into New Look, the big bet that the company made in London, the less we liked it. And we got out of that one, fortunately, as it happens, before the Steinhoff problem hit, and of course the contagion that went on that as well. But that was our previous mandate, and we are changing that mandate by simply taking away hedge against the rand. So the new mandate is invest in South Africa's champion companies driven by its best entrepreneurs. That means that we will be looking at any South African company listed on the Johannesburg Stock Exchange. Remember, that's one of the priorities or one of the requirements for this portfolio. If you need to be listed on the Johannesburg Stock Exchange to make it possible for South African investors to invest in rands. But now we're no longer saying you need to be a rand hedge. We will be quite happy to invest in companies that are fully rand focused, and you'll be seeing that coming through in the next little while. Just to give you an idea of why we're making that is because there has been a structural change, in our opinion, in the rand exchange rate. If you look at that little green circle, it shows you what happened to the rand. Now, this is the rand versus the US dollar. We've been very negative on it for some years now, in fact, going on for 4 or 5 years, because of a view that Jacob Zuma's economic policies were bad for the country's economy, and indeed that would be translated to a poor performance of the exchange rate. We've seen it come to fruition. In fact, the rand has fallen significantly over the last 5 years in particular, and Jacob Zuma's poor economic policies has seen a stagnation in economic growth and in unemployment rate rising. However, all of that now will change, or at least it is in our strong opinion. And you'll remember in our last podcast, our last webinar, we said exactly this. My view right up until the ANC elective conference, and it has been for some months, and I know it was a little bit of a minority view as far as commentators were concerned, but my view was that Cyril Rampahosa would be elected as the new ANC president. The view was based on a feeling or an understanding that there was still sufficient within the ANC to rescue the party, and really on a philosophical base that there are more good people around than evil people, and that the good people would have a look within the ANC and vote for self-preservation, because the way it was going, another 5 years of Zuma-type policies, the economy would have been in dire straits, but more than that, the ruling political party might not have survived it. It is that was our underlying fundamental view, and it was certainly on the 18th of December, it was validated. At the time, you might remember last month, I did say that it was in our opinion that Cyril Rampahosa would be elected, and the problem that would do for our portfolio is that the rand was likely to strengthen significantly, which, as you can see from this graph, it duly has done, but that we weren't going to start messing around with the portfolio at that point in time, because that would be counterproductive. We thought we had we were well invested in most of the companies there, and that we would be refraining from making some dramatic changes. As it happens, last month's big issue that we did discuss was there is Ramaphosa, Cyril, the man who has changed. Why am I so confident about him making it a transformation for the South African currency? Well, because he follows economic policies, or is likely to adopt economic policies which A, attack corruption, and B, promote investment both from the South African community or business community and from international investors. Now, it's very important to realize that there's more than R1 trillion on balance sheets in cash in South African businesses. So all they need is to have the confidence that the economy is going to be going in the right direction, and South African companies will open their purse strings. They do believe, certainly when you talk to business leadership South Africa, or have a look at the comments that comes from there, and when you engage with business leaders in the country, in individual companies, they are very forcefully behind Cyril Rampahosa and the team South Africa that he is compiling, which will be taking the country forward into the future. By contrast, they were very anti what Jacob Zuma was doing in the country. So I'm anticipating that domestically there will be an opening of the purse strings, and on the other hand, that foreign investors, of course, much prefer Ramaphosa to Zuma. And as you start eliminating corruption as well within the system, you will also get the benefit of economic growth on that side. So all round, a much, much happier picture that is likely to be coming through as far as the economy is concerned. And as a consequence of that, we certainly won't be advising rand hedging as a overarching strategy. It's not a bad idea to have a rand hedge component in your portfolio, but in this case, we're looking strongly now for entrepreneurs. Last month can't be forgotten. We did discuss this a month ago, and here is how Steinhoff hurt the portfolio. Remember, it was 100,000 rand that we started with. It wiped out 7,500 rand of what we began with, and we took the decision after 2 days of investigation, and I did send out newsletters to the Biznews community over the Steinhoff matter. In the first one, I said I wasn't sure what was going on. We then investigated further and discovered that this was a real big problem, although Steinhoff itself has still not said exactly where the difficulties or they haven't articulated exactly what the chief executive did. We now know for sure that there has been accounting fraud, and as a consequence of that, we just wanted out. We took the Warren Buffett approach, as he indicated when he sold his Tesco shares on hearing of similar issues. And we dropped out of Steinhoff, and the point now was, what do we replace it with? Well, given this mandate of going for South Africa's great entrepreneurs, there can be few entrepreneurs in South Africa's history who are anywhere near in the caliber of the gentleman you see on the screen there, Brian Joffe. I've followed his career closely over something like 30 years and have engaged with him a great deal. He is not everybody's cup of tea. Joffe is a conglomerate builder in the old-fashioned style. That's not always in fashion. It was very much in fashion in the 60s and the 70s. Joffe has used the approach of a conglomerate to build Bidvest into a magnificent company. He left that business and then recently started Long for Life. Long for Life is going to be taking the 8% of all new money that is invested in the portfolio. So if you decide today you want to put another, if you've got a monthly run debit order that goes into the SA Champions portfolio, the 8% that did in the past go into Steinhoff, and once we got out of there, which was being held in cash, that'll be put into Long for Life. We will be making some changes to the or rebalancing the portfolio in the next month or so, but I've already had it confirmed, and you can go and have a look on the Easy Equities website. Any new fresh money that goes in will go straight into Long for Life. So it's an 8% stake in the portfolio. Why Long for Life and why now? Well, I suppose this probably shows you the reason for it. Long for Life, when it was listed, ahead of its listing, it raised 2 billion rand. Joffe put in 100 million rand of his own money at 4 rand a share. So he paid up 4 rand. He bought the shares himself. Then he had other investors who came in at 5 rand a share. So they started with 2 billion rand. They've made a few investments over the period of time. We don't really have the time today to go through the chapter and verse of it, but the important thing that you must know is that Joffe understands all about allocation of capital, and you can then see that the share price was bouncing along for most of this time at a good premium to the cash value, which one would expect with a entrepreneur of Brian Joffe's caliber. And then round about mid-September last year, it started falling. Well, we didn't get in at the absolute bottom of around 420, 430, but we have now seen that Long for Life is breaking back above 5 rand a share, and I'm very happy to be investing about a year after the initial funders got in there at just a slight premium to what they paid, not at around 5 rand 27. Remember, they invested at 5 rand a share. So we are backing Brian Joffe. We are backing his company, Long for Life. He's completely focused on this business. They've made a few acquisitions already, the biggest of which is More Sport, which you'd know through Sporting Warehouse, etc. We'll get into all of those details, and I'll unpack them in more detail next month as we do the rebalancing of the portfolio for the existing shares. But I am very comfortable that we are on a strong horse here, and that Brian Joffe will not let us down. We are also not buying it in at a significant premium to the underlying net asset value. So all happy days there. Stuart, anything we want to pick up as far as the questions are concerned?
Yes, thanks, Alec. And Margaret, just on the back of the Long for Life discussion, she said, did I miss the answer? What is the anticipated upside of Long for Life?
Wow, that's an interesting question, Margaret. What's the anticipated upside? I don't know. I just believe that you need to be buying into companies that you believe in. You believe in the managers, you believe in the entrepreneurs who are running the business, and that's what this portfolio is focused on. It is also, in this case, along with what Warren Buffett suggests, and that is when you make your investment, find a stock that if the share market were closed for 5 years, you would be happy to be in it. Long for Life is one of those that I'd be happy to be invested in. The upside, well, back Brian Joffe. How good is Brian Joffe? I think he's the best that South Africa has seen in a long, long time. You have to go back to Manny Simkowitz, who Joffe worked for, to find an entrepreneur of a similar caliber. Of course, Becker will be rated by some as an even greater entrepreneur. But what Becker did was he made a incredibly inspired bet on Tencent, which has become the best private equity bet ever. But I think even Chris Becker would say that he was very fortunate in that regard. They're doing good work at Naspers, and we'll talk about that in a moment. But it is one of those companies that could return significant returns for us. When I look at this one, it is going to be a portfolio where Joffe will be investing in industrial stocks and taking opportunistic bets. And he has to be one of the possible beneficiaries of Steinhoff as it starts unraveling and the banks offset or sell assets. Remember, Joffe, with his old hat on at Bidvest, was one of the direct competitors to Steinhoff. So he will see if there's anything from Steinhoff that comes out that is offering and is available at a bargain price. You can be sure that Brian Joffe will be right at the front of the queue making that bet. He's still energetic. He's fit and healthy, and his mind is very sharp. I think that he's the closest thing South Africa's had to a Warren Buffett, as the Bidvest story tells you. So we're betting on the SA Buffett, if you like.
Thanks, Alec. Margaret's got two little follow-ups on that. She asks, is there any connection between Bidvest and Long for Life? And then after that, does Brian Joffe have a strong team with him if Joffe is out for any reason?
Yes. On the first one, there is no connection whatsoever between Bidvest and Long for Life. On the second one, he's got Colin Datnow in there, who is an entrepreneur who's been ran his own business for a long time. He was a non-exec on Long for Life and has recently become an executive director. And the team that Brian's got around him, he's pulled them from various areas where he has worked with them in the past. So remember, when Joffe ran Bidvest, he had a very small head office team as well. So it isn't the kind of thing where he needs lots of people around him. What he did do here was he brought in Kevin Hedderwick from Famous Brands, and the two of them, there's different views on what happened there. I guess we'll never really know the full story, because I'm sure they wanted to part as friends. But they certainly, those two buffaloes didn't sit around the same fire indefinitely. And Kevin Hedderwick has left, and Brian Joffe continues to run the business, which is sometimes not a bad thing. To have almost two CEOs or joint CEOs is not really the ideal situation. You need to have somebody making the decisions. And as much as I respect Hedderwick, I certainly would believe that there are few in South Africa who can stand next to Brian Joffe in that regard.
Thanks, Alec. Just shifting gears, Ed and Benjamin have questions on commodities. Benjamin wants to know your views on the commodity cycle. Has it begun, and is it sustainable with the global growth? And then Ed asked about a company called Tawana Resources. I'm not sure if you have any insight on that.
All right. Well, let's start with Tawana. No, I don't. So it's easy enough to pass that one by. Sorry about that. As far as commodities are concerned, I have a very strong belief on commodities and investing in inanimate objects. You are taking, when you're investing in equities or you're investing in companies, you're actually investing in the human ingenuity. So when you consider the guy on screen, Brian Joffe, his experience and his understanding of how to make good business is what is appealing about Long for Life. If somebody else were putting together a 2 billion rand portfolio, or put 2 billion rand in cash together and said, back me, you'd have to ask to begin with, well, what is your track record, and why should we be giving you the money to invest or to buy companies on our behalf? It's a similar thing when you look at commodities. Commodities are inanimate objects. You buy a commodity today on the belief that in future the value is going to go up. There's quite a lot of working at the moment, or quite a lot of heat around platinum, for instance, where some believe that the platinum price has fallen too far, and that the platinum price will in future rise, and that you should be buying platinum now. I can't understand that, because when you invest in the big trends, it is so difficult to get it right. Whereas if you invest in human ingenuity, you've got a track record to go back on. You've got valuations of the company as they're standing at the moment that you can take into account, and you've got the likely future that you can predict in your own minds if you see how the company is growing. So commodities, I'm afraid, I don't know anything, or rather, I don't believe, from where my expertise lies, that I can call them one way or the other. and commodities have over time been the graveyard of many investment reputations. So maybe it is the beginning of a new super cycle. From where I'm standing, I would rather not be the one trying to make that call.
Thanks, Alec. That's no questions at the moment.
Okay, so there we go. So Long for Life is our new stock that we've got in the portfolio. And that's what is happening to the SA Champions portfolio as of now. We've had a very good month. Last month, with the wipe out of Steinhoff, it pretty much put the portfolio back to where it began a year before. So it got down to just over 100 or just under 101,000 Rand, remembering that we invested on the 23rd of January 100,000 Rand. That 101 has now gone up to 106.5. So it was an excellent month for us. But as you can see, we're way behind the JSE All Share Index. And that's not surprising, because when you have a hopefully once in a lifetime experience like we had with Steinhoff, it does have a big dent, or will make a big dent relative to the market generally. But as you can see there, the stalwarts in this portfolio, Naspers and Discovery, have both performed unbelievably well for us. And then we've also had a big win on FirstRand, which was only added to the portfolio a few months ago. MTN continues to disappoint. It is bouncing around at the moment, and the shocker for us has been Mediclinic. And you have to then look at Mediclinic and start making your view on whether or not Mediclinic is worth keeping in the portfolio. Remember, I said earlier that we were talking about a mandate which says we are backing South Africa's best entrepreneurs. Well, it looks like Dani Mankies, who's going to be leaving Mediclinic in the course of this year, hasn't been able to qualify in that category as well. So, well, we've got a turnaround there versus entrepreneurs. It is a conundrum that we are dealing with and working on at the moment. And then the other member of this portfolio is Investec, and the great entrepreneurs there. No doubt, in my mind anyway, that the share price will reflect that in due course. But the portfolio as a whole up 6.5% year on the year. At least we've got growth, but it certainly isn't anything to shout about. Not at this point anyway. So moving on to our individual stocks in the portfolio. And the big thing here, the big story of Naspers in the past month was the Investor Day that was held on the 12th of December. I listened to it. It was a very strong performance. And I would suggest, given that Naspers is such a big part in this portfolio, it would be an idea for you to go onto, what do you do? Just Google Naspers Investor Day and go and have a look at it, and you can unpack from there exactly what's going on in this company. The reason they had the Investor Day in New York, and it's the first time ever, that, by the way, on the left-hand side is the Chief Executive, Bob van Dijk, and he is together with the Chairman, Koos Becker, the driving force behind Naspers. The reason they had that was because Naspers's value on the stock market was trading at a 38% discount to its underlying assets. And the most important of those underlying assets is Tencent, which is listed in China. And the inaugural day has had an impact. And when you look at this, you can see towards the end of December, when you look at the bottom, this is the chart from the Wall Street Journal. When you look at the bottom, it's the volumes of shares traded. And when you pick that up, you can see late December, early January, there's a spike. Suddenly, it's over, the trading there goes over 5 million shares. And that's the reason for that is directly related, I would venture to suggest, to the presentations that were made in New York. If you start bringing in global investors into a stock like Naspers, it can make a big difference. Now, Naspers was trading at 40% discount. So really what you were doing, if you wanted to buy Tencent, which is one of the big top 10 companies now by market value in the world, you could get a 40% discount by buying Naspers. You got everything else thrown in pretty much for free. Naspers believes, Bob van Dijk believes, and he articulated this at the Investor Day, that you can probably justify a 20% discount because it is a holding company. And holding companies tend to have a discount on the underlying asset that they have. But The other half of the discount, in other words, the other 20% of the discount, he says is directly related to South Africa. I want you just to look at this again, at this graph very carefully, and the share price graph at the top, which went from 4,000 Rand a share and went all the way down to, well, below 3,500 Rand a share. And then you have the turnaround, and that turnaround again, it correlates very closely with the Investor Day in New York. So that was quite a big deal. Remembering also that Naspers' biggest investment is in Tencent, and Tencent is priced in Hong Kong dollars, and the Rand has appreciated dramatically, as we saw earlier, since Cyril Rampahosa coming in. So if you then cut that off and you say, if you were to put the Rand, had the Rand remained flat, not appreciated with the Ramaphosa election, and you still had this appreciation in the share price of Naspers, you can then kind of understand that going up from, say, 3,250 to around 3,750, where it is right now, has to be directly related to this communication that has gone out into the marketplace and the new fans who've come into the Naspers orbit. This is what they're trying to sort out. Naspers in the last year has risen 70%. Incredible and a fantastic return. It's the black line. But Tencent, which makes up more than 100% or more than all of the Naspers share price, is up 128%. So in essence, had the two of them just moved together, Naspers' share price would be 58 percentage points higher today. So all it had to do was just to track what was going on with Tencent. But it hasn't, and that's what we talk about with the discount with Tencent and how that has widened. The first point then, pretty obvious, let's try and get that discount together. Let's try and get Naspers just reduce that discount and just to start reflecting what was going on in the Tencent share price. Is Tencent overvalued? Well, many people believe not. It is now starting to come more and more into the portfolios of Western investors. And within China itself, it is a different model, completely different model in China with these big tech companies to that what happens in the US. In the United States, their big tech companies are fighting with the government all the time. Silicon Valley takes pride in not being a Trump support or not being Trump supporters. Whereas in China, there is a very different situation. The big three, or the BAT as they call it, that's Baidu, Alibaba, and Tencent. Those big three are very closely aligned with government. And when President Xi is in the same room as Pony Ma, who's the chief executive of Tencent, there's no doubting who is the senior partner in all of this. So if you get that and you start saying, right, so in China, we have these big three tech companies. They are very closely related to the government. What is the government going to do? It's going to suggest to them to move in one direction, but it's not going to hurt them. It's not going to smash them. Whereas in the United States, you have much higher valuations on the Silicon Valley stocks and than you have on Tencent, Baidu, or Alibaba. Yet they are fighting with the government all the time. So there could be legislative issues or legislative risk there. I think this kind of unpacks the whole thing for us and why we are very happy to have a third of our portfolio roughly invested in Naspers. Moving on to our star performer of the portfolio, more than 50% gain since we bought it a year ago, or just about a year ago. Adrian Gore and his creation, Discovery Health. And in the most recent few weeks, Discovery has been a runner. Now, again, have a look at those volumes down the bottom of the charts, and you'll see a very, very strong demand for the stock just after the appointment of Cyril Rampahosa as the new chief executive of South Africa Inc., if you like, by being the new president of the ANC. There you are seeing what the international community believes Ramaphosa will be doing to the economy. International community then looks at that, tries to find shares within the country which will benefit from a move or a shift in the way that the country is managed, and massive volumes in Discovery and a big uptick in the share price. We invested in Discovery initially as a Rand hedge because of its a significant operation in the UK and elsewhere, but primarily Vitality Health in the UK, which is a company that is doing very, very well. Not just you won't just see the branding on the football field. If you go anywhere in London, for instance, you will see Vitality Health branding plastered in strategic places, and the market shares are growing. The life assurance business, as in South Africa, has been a very strong part of the company. Vitality is doing well, Discovery is doing well, but now that discount that the Discovery operation had because of its South African businesses is turning into a premium, and you can see the significant improvement in the share price as a result directly of Cyril Rampahosa's election. And Investec, on the other hand, has had something else to deal with. That's Stephen Koseff, the chief executive and co-founder. I took that photograph in Davos and look forward to seeing him again. Can you believe it? Davos is to come around again. It'll be next week. But Stephen's company has been underperforming, and it went the other way in the early part of December. As you can see, went down from 95 to 85 Rand directly as a result of the Steinhoff debacle. And that is because Investec was perceived to be exposed to Steinhoff. As it happens, the exposure is about 3% of its after-tax profits. So it has quantified that. And that is not something that we need to worry about too much as far as an investor is concerned. Indeed, you shouldn't be marking down or losing 12% of the equity price on a 3% one-off or 1 year difficulty a 1 year difficulty that would be coming through the income statement. But as you can see, since then, since Investec clarified its positioning as far as Steinhoff is concerned, the share price has improved, and it's also benefited from that late December Ramaphosa effect, if you like, and Investec. As things are standing right now, lots is going on in Investec all the time, but the latest deal that they did, which gives again an indication of the benefits of having a company that is plugged into the global market, is that they've got together with a company called Market Invoice, which is a fintech company in the UK, and they're going to be funding the first £50 million of invoices from this fintech company. So they've found a fintech company that they really like. They're partnering with them. And this is the trend internationally with banks. Whereas in South Africa, you might have seen on Biznews yesterday that Michael Jordan is now starting a new fintech-related bank, which will be an app, really, and that you'll be able to manage your money through an app. What's happening internationally is that there isn't this competition, that the big banks are now starting to get closer to the fintech players, or at least they're talking to them. And Investec is the first of the major banks to do a deal here in the UK with a fintech operation in this field. So it's to do with client-focused banking services that Investec is now seeing can be handled better, outsourced by a fintech operation. Fascinating stuff, but being plugged into the London market does give them that advantage. They also did a very interesting little deal where they picked up, together with a company called Shawbrook, £150 million of a book that is owned by the Lombard Finance Division of the Royal Bank of Scotland, or RBS. The new laws that are coming in the UK, and RBS had to divest itself. It didn't want to, but it had to divest itself of this book. So Investec was there to pick it up. So good news for Investec. It's a fantastic business. If you are a client of this company, as I am, you can just see how far ahead they are, not just in South Africa as far as private banking is concerned, but here in the UK as well. And this just hasn't translated yet into the share price. In time, though, it's one that I'm very happy to stay with. Here's one that you have to be scratching your head about and wondering whether we made a terrible mistake investing in the first place. Well, Mediclinic was the 5th worst performer of the FTSE 100 last year. And that graph, which shows you the JSE price, kind of reflects it all. It's been a slide. It listed on or got into the FTSE 100 It was aggressive in its acquisitions, and for many, it was a company last year that just lost its way. And what exaggerates the problem for Mediclinic is that you might remember it was in a takeover battle for a company called Al-Noor. Mediclinic has really got three major assets. It's got Switzerland, which is the biggest asset. It's got a Middle Eastern asset called Al-Noor, which is losing money but is turning around. And then, of course, it's got its South African operations, which, as South Africans, we know very well. And in the Middle East, it was in a takeover battle with a company called NMC Health for Al-Noor. Mediclinic won that takeover battle. But what's interesting, or ironic, I suppose, here, is that NMC Health was the number one performer on the FTSE 100 last year. So the company that lost out in buying Al-Noor against Mediclinic was up 90% its share price on the FTSE, whereas Mediclinic went the other way and was one of the was the fifth worst performer. What next? Well, we're in there. We're invested there. We like it because of its international coverage. We like the Swiss story. We like the turnaround story in the Middle East, and it does seem to be starting to happen. And I guess if you were to look at NMC positively, at the very least, you could say, well, if NMC can do that, and it comes from Abu Dhabi, or the Middle Eastern area where Mediclinic is also very strong, surely it's possible for Mediclinic to do it. The other big bull point that I would say from these levels is reflected in the next graph, and this one is showing you Mediclinic's share price in London. Now, there you have a continuous slide down to 500p until late November. And then there is a definite and a distinct turnaround in the share price and a turnaround in the perceptions amongst UK investors. And this is where this price is being made now. As a FTSE 100 company, Mediclinic's it will be determined, its long-term future will be determined, the share price anyway, in London, not in South Africa. Of course, the South African graph is showing you a continued decline because this improvement from 500 to 600p in the share price in London has been offset, of course, by the Ramaphosa effect, because Cyril coming in has meant the South African rand has gone up. So that's why you're not seeing this improvement being reflected in the South African or the JSE price. But it's an interesting turnaround, which began when Mediclinic walked away from what was being feared to have been a hostile takeover bid of Spire, which is a private hospitals company in the UK, in which it owns 29% at the moment. So it put a bid on the table. The Spire directors said it wasn't enough. And as a consequence of that, there was a fear that Mediclinic would get into a hostile takeover battle for Spire. It didn't. Sanity prevailed. The Mediclinic CEO is going to be leaving this year, and the market is now starting to give them a little bit more credence. What you need to see from Mediclinic is an improvement in the Middle East and possibly some kind of a friendly tie-up with Spire. Also, what will be interesting is to see how they replace the Maintjes as the CEO. But the chairman is the entrepreneur behind all of this, Edwin Herzog, and he's still very much involved in the business. And remember, it's also part of the Remgro group. And what was interesting in the Remgro statement recently was that the view that Mediclinic had actually hurt Remgro a lot in the past year, but they are expecting there to be a significant turnaround, and the quotation was Al-Noor is now turning the corner. So that's the swing factor as far as Mediclinic is concerned. And when you think about selling out of a stock like this, you have to think very, very carefully that maybe you're throwing bad money, or you're throwing out, you're getting out just before you get to the finish line. And on this one, I'm inclined to say we stick with Mediclinic, certainly in the near term. Here's one that has really, really sorted or played well for us. We invested in FirstRand on the strength of its 20 billion rand acquisition of Aldermore in the UK. But now we would have it in the portfolio anyway because of that wonderfully entrepreneurially driven business in South Africa. And again, you can see the Cyril factor. And my goodness, is that reflected here? If you look at on the bottom of the graph, you have once more very strong volumes between late December, 18th of December, remember, was the when Ramaphosa became the president in waiting, and the share price of FirstRand surged from the mid-50s to the late 60s, and then came back to its current level in the mid-60s. That is based on the view that banks benefit when the economy benefits. If you're in an economy that is under pressure, then banks cannot flourish. If, however, the economy is growing, then the banks are the first to benefit because they can start lending again. Remember, banks are actually in the business of lending money. They take in deposits and they pass those on. They lend them on to people at a higher price. They pay a low price for deposits, i.e. lower interest rates, and they lend on that money at a higher price to people who want to borrow the money. The trick for a bank is to try and have as few bad debts as possible, and that is directly related to what happens in the economy. When the economy is growing, the bad debts fall. When the economy is contracting, the bad debts rise. You know that. It's a law of economics. It's a law of life. If if economies are under trouble, companies go bankrupt, and banks are the ones who pay up. FirstRand has not been exposed to Steinhoff, and that's a beneficiary there as well. You can see the difference, perhaps, in the FirstRand performance with Investec. Although on the one hand, Investec, of course, has got a big UK operation, so that would have been hurt by the surge in the rand or the valuation thereof. But on the other hand, FirstRand not really being exposed to the Steinhoff debacle. The big exposures there lie, would you believe, with Sanlam, which gave Marcus Jooste 800 million rand, and on the strength of the security of Steinhoff shares. And of course, Sanlam are going to take a big knock on that. And Investec and ABSA, who are looking for the liquidation or the sequestration of Marcus Jooste. But as far as FirstRand is concerned, they've now they've done the deal with Aldermore, so they do have that international opportunity. And within South Africa, the improved economic outlook has a huge impact on this business. And then finally, there's Phuthuma Nhleko, one of the great entrepreneurs to come out of South Africa. And this is MTN, a stock that we're still expecting in time will be giving us good rewards. It's got a new management team. There's been a slow and steady improvement from around mid-year, as you can see there. We got down to as low as 110 Rand a share in June. We're now comfortably above 130, so it's been a nice improvement. That was primarily due to undervaluation. Around about mid-year, what knocked the share to get to its rock bottom was Turkcell, which had lost the bid on the Iranian license to MTN. What happened was Turkcell was given the license in Iran first, and then MTN later got it. They changed their minds. Whatever happened behind the scenes, Turkcell says there was skullduggery. MTN says there wasn't. There was an MTN former employer who's turned over and is working with Turkcell, and Turkcell wants $4 billion from MTN. They have been unsuccessful in the American courts. MTN got a judge from the UK, presumably gave the judge every bit of evidence that was there, and the judge came out to say MTN is in the right here, and their legal counsel believe they're in the right as well, that there's no skullduggery that came from their point of view. But anyway, towards the middle of last year, Turkcell got permission to sue MTN in the South African courts. These things take a long time. In fact, the story has been going on since 2013, and that has remained as a little bit of a depressant on the share price. Also depressing the share price is the consequences of some fairly poor managerial decisions in years gone by. That's now all being turned around. Phuthuma Nhleko took a much more active role in the company. He is chairman, he's non-executive chairman, but he became the chief executive for a period of time. He brought in Rob Shuter, who was running Vodafone Europe, so very heavy hitter, and Shuter's then surrounded himself with some top people as well, including the likes of Steve van Coller from ABSA, who used to run ABSA Capital. I believe, and it's getting back to that discussion we had earlier about investing in commodities. I believe that when you invest in human potential and human ingenuity, that is where your returns are the greatest when it comes to the stock market or in equities. And this is a group of people where the ingenuity could hardly be higher. Phuthuma put a really good team together, and let's see how the team performs. It's still early days on this one. They've got lots to turn around. Remember, 25% of their revenues, and that also helped the Cyril factor, if you like. If you look towards the later December, after the ascension of Ramaphosa, there was a big volumes on MTN, share price improving as well. So 25% of the revenues come from South Africa, still very important. More important is Nigeria. That seems to be stabilizing after its difficulties with the oil price or the impact of the oil price collapse there. It's lots of work to be done, but it looks like it is starting to pay off at MTN. So we're very happy. I'm very happy to be invested in that stock as well. And here we go, just to finish off with for the last of my slides for today. And it shows you the portfolio. As mentioned before, we are now 6.5% up. So we've gotten rid of the Steinhoff problem. We will be rebalancing the portfolio to bring long for life in there. But if you are investing new money, so if you put 500 Rand in today through Easy Equities, it would go, 8% of that would go directly into long for life. Well, Stuart, that's the story for the day.
Thanks, Alec. Yeah, a bit quiet on the Q&A dance for this side. I suppose 2018, the leaves are still kicking into gears, they say. Just a final one from Sudhir. He says it goes back to long for life. He asks if it's trading at a discount.
No, it's not. It's not. It's trading at a slight premium. The stock was bought at just under 5 Rand a share. So the net asset value, if you like, the cash value of that company is around 5 Rand a share. It's just under 5 Rand a share. So it's at a slight premium, but it's not that easy to calculate. And the reason for that is that there have been a few acquisitions already that have been made. My sense of this is that Brian Joffe's made the acquisitions at good prices. The market wasn't too excited about the More Sport acquisition. They felt that because of the revaluation of that deal, that he might have made a misstep, and that's one of the reasons why the share price did come back over that period. But Joffe will be almost certainly, you can almost certainly guarantee that he's not going to overpay for any of the acquisitions. He built a successful conglomerate on that basis at Bidvest, where he made deals where he bought earnings at lower multiples than his price was trading at. And what he's been doing at Long for Life in the initial stages anyway is he's been using part of the cash, but he's also been using shares, and he's been issuing shares at around about the current share price or even higher. So you might also have noticed, if you follow these things carefully, that he's managed to, the former chief executive of More Sport has departed. He's sold 10 million shares in this company, in Long for Life, and he has departed the company, which then gives Joffe the ability to put the person he wants to have in running that business, given that it's now part of his operation.
Excellent, thanks, Alec. I think that's it. I haven't received anything further.
Well, it's good. I look forward to just one last final point before we say goodbye to all our Biznews Premium subscribers, and thanks for being with us today. We have from next month, this discussion is going to be a little different. We're going to be talking about the SA Champions portfolio, which is with Easy Equities, but we're also going to be talking about the Biznews Exponential portfolio, which has been is the one with Easy Equities where it's invested in US dollars. So we've got the two bundles with Easy. This is the one, the South African one, where it is restricted to JSE listed shares. The other one, which has been it's been an incredible performer in the few months that we've had it going, the Exponential portfolio, that is one which is invested in US stocks. So both of them you can buy through bundles. Both of them you can put minimal amounts of money into it. I think the one-off investment starts at about 250 Rand. And it's similar. The Biznews exponential portfolio with easy equities is similar to the global portfolio, our portfolio, which, as you know, we run with Standard Bank, and that's the one that's been it's been defying gravity. It's been going for 3 years now, and it has generated over 30% compound per annum. The last numbers were around 35% in South African rands. With the rand improvement recently, it's probably going to knock that back to around the 30%, but that's still a huge return thanks to our investments there in the likes of Amazon, Google, which is now called Alphabet. Tesla's done amazingly for us. Tencent has done amazingly for us. So the difference between the two is that the easy equities one is just US stocks, whereas the Standard Bank one is global stocks, and we have a couple of non-US stocks in that portfolio, being the two there being Tencent and Metrobank from the UK. So next month we'll be talking in this webinar. We'll be talking about two portfolios, SA Champions and the exponential portfolio, both of which you can invest in very easily through easy equities. And at the end of each month, so mid-month we talk about the easy equities portfolio, if you like. End of month we'll talk about the Standard Bank portfolio, which is the global portfolio, the one that we started everything going in December 2014. I hope that kind of clarifies things on that, Stu.
Thanks, Alec. I think you tweaked Margaret's interest with the US-based portfolio. She wants to know if it's a good time to be buying into a US-based portfolio right now.
Certainly the one we have, absolutely. I don't think it's been a better time. We haven't, you'll notice, Margaret, that we haven't really been promoting it. And the reason for that was in the run-up to the ANC elective conference, the view being that if Cyril Rampahosa were to win, and we gave that a high probability, then the rand would appreciate. And if you put cheap rands into that US portfolio, clearly you'd be starting on the back foot. But now that the rand has done its bit, it's a very, very good time to start investing into that portfolio. So yes, good call, and it's available. What I love about it, it's just so easy. You don't have to go and start finding fractions of how much do I buy in Amazon and Alphabet and Tesla, and what's the breakdown in the portfolio. It's all done for you. You just give your 250 Rand and that's then allocated to the first of all into US dollars, and then secondly into those stocks. So it just makes investing easy. I suppose that's why they call themselves easy equities.
Thanks, Alec. Final question quickly from Anthony. He says, I'm an investor, not a trader. Would my losses on Steinhoff, which I've held for less than 3 years, be deemed a capital loss to be offset against future capital gains?
Sure, that's outside of my area of expertise. So I'm afraid I'm going to have to come back to you on that one. My colleague Matthew Lester is very smart on these things. I guess what we need to do is to get hold of Matthew, ask him to write us a little piece on it and to explain it. I think there would be many people who are sitting in exactly the same position. Of course, if you're investing in the bundle, then the impact of it is going to be the bundle overall, and much like if you were investing in a unit trust. If you're investing, until you start selling, you won't be in a position where you have to worry about capital gains or losses. So that it's a question just for those people who are trading, and if you're an investor, you wouldn't really be trading. But let's ask Matthew to give us some insights into that. I don't want to guess.
Perfect. I'll pass it on to him, Alec. That's it from my side, Alec. Thanks for everything. It's been a great one.
Thanks, Stu. And isn't it nice to be able to have a look out the window here at our office?
I've seen a few red buses pass by, Alec, as well as the black cabs. So.
I didn't want to show you. I won't show you the extent of this office, because if you can imagine, London accommodation or office accommodation, the prices are, well, we just can't get our heads around it from a South African perspective. But if you can imagine, it is 2 meters by 2 meters. So put that in the background, but there are lots of people walking past here. It's a lovely vibe. WeWorks is an amazing facility. They tell me that they're looking to do something similar in South Africa as well. And I guess when they do, I think they're going to be oversubscribed. There are South African businesses who are doing the same thing, this shared office space. But having tasted it, you wonder why people would take long leases or even bother with long leases when you have got this option. You can rent month to month and expand as you want the space, only as and when you need it. It really is a new phenomenon, and something that some South African companies are starting to get into. Maybe we should be looking at that one as well as an investment proposition. But generally speaking, it's been lovely coming to you here from London. There's another red bus as we bid you adieu and look forward to being with all of you, the premium subscriptions. And thanks again for your support on our premium service. We got big news on that as well, which will be, Stu, I think it's in the next week. I know the contracts are all signed, but we can't say anything because it's a big partner. I think it's the next week or two. Anyway, after Davos, we'll be able to bring you up to date with that news as far as your premium subscription is concerned. And what I can tell you is you're not going to be sorry. So that's it from me. Until the next time, so long.